Hi, everybody, and welcome to part one of the lecture on chapter 8. Today, we're going to be talking about the first part of designing your pay structure inside your organization. If you remember before we left for spring break, we talked about the entire part of internal alignment. That included all job evaluation methods, including the point method, the skills method, and the competency method. We also started talking about external competitiveness in chapter 7. The first part of external competitiveness is always establishing internally what your pay policy will be. We talked about 3 different pay policy decisions that your organization could make. An organization can choose to lead the market, lag the market, or match the market in pay. We also talked about a variety of different pay policy mixes that an organization can adopt. We talked about a work-life balance mix, a performance-driven mix, a market match mix, and a security mix. Each one of those should be aligned internally with what your organization's strategy, goals, and values are. It needs to match your organization's culture. An organization that's very driven by sales and performance, for example, needs to offer more in terms of bonuses and incentives than base pay or salary. So today we're going to talk about the second part of external competitiveness. After you've established internally what your pay policies are going to be, you need to explore externally what your competitors are doing. What are they paying for jobs that are similar to jobs inside your organization? And we do that in a variety of ways. The first step always in external competitiveness is establishing your pay policy, which is what we did in chapter 7. The next step is to select your market. What competitors are most closely aligned with you? For example, if you're running a call center in a certain geographic area, and there's a call center down the street from you, that is your closest competitor. They are competing with you for the same external talent. They want to attract the same people, bring them into the organization, and retain them. So how do you compete with those particular competitors? Beyond those that are most closely related to you, how do you want to collect data from other external competitors? Do you want to go beyond your geographic region, outside of your state? Which market do you most closely compete with, and which organizations are vying for the same human capital that you are? Once you've identified your market, you need to design what we call a salary survey. Salary surveys are done in a variety of ways. Traditionally, we typically just call our competitors and ask them for information about pay for similar positions inside their organization. While you might think that these competitors would be reluctant to provide that information, there's actually a very collaborative environment around doing salary surveys. And most companies will provide that information to you because they know that they need that information later on. For the part 1 of this lecture, we're just going to be talking about the salary survey. In part 2, we're going to be talking about drawing market pay lines and merging our internal and external data to create our pay structure. So let's just talk about salary surveys today. What's the purpose of your salary survey? Organizations do salary surveys for a lot of different reasons. Sometimes they just need to adjust or align certain pay levels in their organization in response to competitor changes or market changes. Sometimes they need to change their mix of pay forms. For example, an organization that was traditionally very market driven might see that their competitors are becoming more performance driven. How does that organization need to change its pay mix in order to be competitive? Do they need to lessen the amount of base salary they offer? offer more in short-term or long-term incentives or bonuses? How do they compete with those external competitors in terms of attracting and retaining human capital? Oftentimes, an organization will need to price their entire pay structure, meaning that they have not done a salary survey in a long time, and they might have found that they're now lagging the market in pay for their jobs when they really want to be matching the market. Sometimes an organization will want to add one particular job to its pay structure. Maybe it's a job they've never had before, a brand new position, and they need to find out where that position falls in terms of their larger pay structure, how much that job should be priced at, and how much that job should earn in terms of base salary, incentives, and benefits. Oftentimes, organizations will identify specific pay-related problems that people are working under market value when they want them to work above market value. All of these reasons are reasons why an organization might decide to do a salary survey. Typically, an organization should do a salary survey every 3 to 5 years, but there's a lot of organizations that lag far behind this trend. Some don't do them for 10 years. And what they find in doing the salary survey is that they're paying well below market value when their whole aim is to be highly competitive. So how do you do a salary survey? The first step in deciding how to do your salary survey is to decide which companies should be involved. Which companies do you want to collect data from? Are there some regional employers that are most competitive with you in terms of attracting and retaining talent? Do you want to go beyond your regional area to the entire state? What about beyond state lines into other states that might have similar positions and might be trying to attract the same talent? Ideally, you want to collect data from the right size sample. Those organizations that are most closely aligned with yours, where you see that the competition is rigorous in terms of attracting new talent into your company. How many employers do you want to involve in your salary survey? Is 5 enough? How about 10? It all depends on the quality of data that you get. Typically, we want to have a representative sample of other organizations, companies that are about the same size as us, that employ the same types of employees that we employ, and that have similar demographics in terms of their market and their competition. Which jobs do we want to include? This largely goes back to the whole purpose of our salary survey. Are we redoing our entire pay structure? Or are we simply adding one new job that we need to price into the organization? That will tell us how many jobs we're collecting data on. And then finally, what information do you need to collect for each of those jobs? Are you collecting just information on base salary, or are you collecting total compensation? In addition to compensation data, do you need to collect organizational data? What's the size of that company? How large of a market share do they obtain? And are they really competitive in terms of attracting the same type of talent as you? Do they adopt the same pay mix policy? Are they performance driven, where your company is more work-life balance driven? These are all questions that you need to answer before you make your first call or collect your first data point. In addition to calling companies, there's a lot of data that's readily available online. Websites like salary.com or payscale.com will allow you to type in any job title in any regional area and see what the median salary is for that job. They'll tell you the median salary as well as the lower 25th percentile and the upper 75th percentile. Why might a job be paid in the lower 25th percentile? Maybe there's additional money that's being paid out in bonuses or incentives that's not included in this base pay value. Maybe there's additional money in benefits. What about the upper 75th percentile? Maybe that organization adopts a security pay mix policy. The majority of their money is paid out in base salary, with very, very little paid in bonuses, incentives, or benefits. Websites like this give you really good information, but it's always better to call individual organizations to collect that information firsthand. When you collect salary survey data, what exactly are you collecting? This becomes really, really important. If I just called a company and said, how much do you pay for your senior accountant position? Chances are they're just going to give me the base pay. They're not going to tell me anything about total cash, which is base pay plus bonuses, or total compensation, which is base pay, bonuses, stock options, and benefits. What I ask for is what I'm going to get, but I have to know what information is being left out. If I called an organization and said, what's the total compensation for a senior accountant, they might tell me $125,000, but I still don't know how that money is split out based on base pay, total cash, or total compensation. I have to be very specific in what I ask for and very specific in the type of data that I'm getting. Otherwise, I might just get base pay from one organization and total compensation from a different organization and not know why those two values are so drastically different. After I've called all of my companies and collected data, the next step is to verify and validate that data. I need to first check for the accuracy of job matches. I might call the position senior accountant in my organization, but that might go by a different title in other organizations, director of accountancy or executive of accountancy. I cannot make sure that that job, my job, matches their job unless I have an actual job description. I need to make sure that I'm collecting salary data for a job that's absolutely comparable to the job I'm trying to price inside my organization. I also need to check for anomalies and outliers. These two things kind of go together. For example, if I called 4 organizations and they said that the base pay or base salary for a senior accountant was $80,000, $85,000, $90,000, and $75,000 respectively, the 5th organization I called, they might say it's $35,000. Why is that the case? Why is that an outlier? Are they just giving me information about base salary and not incentives or bonuses? Maybe they adopt a performance-driven pay mix policy where they give a lot of money in commissions. I need to find that information out and figure out whether the information they've given me about their job matches what I need for my job. Once I collect all of my data, I need to represent it in a frequency distribution so I can see how all of the numbers lay out. And I also need to compute measures of central tendency. Not to go all crazy statistics on you, but there are different measures of central tendency that tell me about the distribution of any set of salary data that I have. There's basically 3 that we talk about with central tendency: the mean, the median, and the mode. The mean is the arithmetic average. If I were to add up all of the numbers in my data set and divide them by the number of data points I have, I'll get the mean. The median is the middle number. If I were to arrange those numbers from lowest to highest and count in towards the middle, it's the very middle of the distribution. The mode is the most frequently occurring number. So if out of a data set of 10 data points, I have 5 that represent $80,000, that would be the mode, or the most frequently occurring number. In statistics, we use the mean a lot because in a normal distribution, it tells us what the average is. And that's usually pretty representative of our data. But what you're going to find in a distribution of salary data points is that the median is often better. Let's take an example.